I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Roll call, please.
Can we hold on? We need to figure out how to start recording.
Okay.
Oh, the cell phone's off.
Brian, should I do it the easy way?
I
Just
think we
record
are
it?
recording now.
Are we good? Maybe you erred. Roll call,
Commissioner
please.
Macris,
Yes.
Commissioner Cohen let us know that she had a conflict and will not be available today. Commissioner Bridges,
Present.
Commissioner Driscoll,
Present.
Commissioner Myberger,
Here?
Commissioner Paskin Jordan,
Here.
Commissioner Stansberry.
Present.
Quorum is present.
Great, thank you. Next item is public comment. Any member of the public who would like to address the commission for a non-calendared item can do so now. Seeing none, I will, saying yes.
Hello, we are indeed here.
Is it familiar face?
Welcome.
Thank you very much. My name is Jed Holtzman, for those of you who don't remember me from 2 months ago. Here from Fossil Free SF and 350 SF, we represent 800 San Franciscans who are concerned about our climate. Hope that you had a good holiday. Having offered further information and resources about the issue that we had before the board to the executive director in our November 4th letter to SPURS, and noting that the social investment procedures were not reflected in any way on November's meeting agenda, we decided to give the retirement board at large a break from our presence that day, which you hopefully enjoyed. We did want to point out, however, that when we spoke with the executive director on October 8th, and he educated us about staff needs to implement tiers 1, 2, and 3 on the carbon tracker list of companies, he indicated that a tier 1 report would take staff between 30 and 60 days to turn around, with 60 days as an absolute maximum. Notwithstanding that and the board's October 9th vote, when we reached out to the board secretary a few days ago, he said that there was no report on the tier 1 action that you unanimously voted on in October on this meeting's agenda. We understand that the October 9th motion also called for studying the potential for tier 2 action, and that individual commissioners additionally called for staff to look into particular research topics. But it was unclear these would alter the expected timeline substantially, so we wanted to check in on your understanding of the implementation pathway for the board's unanimous October 9th vote, and when further discussion and/or action would be calendared. We also wanted to make sure that you guys were aware that since we last spoke with you, Bloomberg has implemented a carbon risk valuation tool into their ubiquitous Bloomberg terminals. It has not been widely written about, but here's an Atlantic Monthly article about that and the carbon time bomb in your retirement account, which I will give copies to the board and the staff. Lastly, we just wanted to make sure that you were aware that there was a conference coming up next month pursuant to this issue. That would be a statewide conference, and we would love to give you more information about that, which my colleague will do now.
Hi, thank you. We wanted to invite you to.
Name?
Sorry.
Please state your name for the record.
Oh, sorry, Kimberly Peichel. I'm also with Fossil Free SF, part of 350.org. We wanted to invite you to the California Divestment Forum. 350.org had put together a similar forum in Seattle on risks and benefits of divestment, and this will prove larger. It's being held in Berkeley on January 22nd, and I'll be sending an email link as well, which will allow you to register. I think it will be a very interesting event. It's bringing together people from all around the state, even though it is in Berkeley, they'll be coming in. And, it's people from government, financial heads, university endowments, and then some of the speakers that are coming as well will be Bob Macy, the CEO of Sustainalytics, RBC, representatives from Trillium, Aperio, Green Century, Impact, Solar Mosaic, As You Sow, and then other, again, city representatives from across California, not just San Francisco and Berkeley. So I'll just give these to Jay, since he's right here. And we'll send an email as well. Thank you.
Great, thank you. Anybody else? Seeing no other speakers, I will close public comment. Item number 1 of the agenda is approval of the minutes of the November 13 board meeting.
I'll move adoption.
Is there a second? Second. Any discussion? Open up for public comment on item number 1, approval of the minutes. Seeing none, I'll close public comment. All those in favor?
Aye.
Passes unanimously. Let me just say. Okay, if you are here for item number 4, Judge's Retirement System item, that item will be continued to the January meeting. And I will take item number 2 and 3. Those will turn into discussion items only, and we will defer the action portion of both of those items to the January meeting. Could you call item number 2, please?
Number 2, Chiron Consulting Actuaries response to the actuarial audit report, presentation of potential actuarial method changes. Rasmussen.
Jeanette Brazelton, Actuarial Services Coordinator. There are 2 actuarial items on the agenda today. The first agenda item is Chiron's response to the actuarial audit, which was completed and accepted by the board at the November meeting. Chiron will also present both recommended and potential funding method changes that will impact the contribution rates and future funding levels of the retirement system. The second agenda item is Chiron's presentation of their economic experience analysis for July 1, 2013 valuation. And for informational purposes only, I have provided the board with a summary of the assumptions and methods for some of the local retirement systems. From Chiron today, we have Ann Harper, Ken Kent, and Bill Hallmark. Bill and Ann were here in September to discuss the new GASB standard 67 and 68. And Ken Kent is here today. He has been a part of the Chiron team since the initial transition in 2008. He is a principal consultant actuary at Chiron and has over 30 years of pension plan experience. He also specializes in financial reporting and investments.
Thank you. I'll start us off. You have in your materials our formal response to the audit. We weren't planning to go through that in any detail at all. We wanted to focus on this discussion of potential funding method changes, but we would take any questions you have on that audit either now or at the end. But hearing I think I'll move ahead to the potential funding method changes. As Jeanette said, we were here back in September talking about the changes of implementing GASB 67 and 68 and how that might influence your decisions on funding policy changes. We now have the audit from Milliman that suggested some additional changes. We understand the charter has some flexibility in the amortization methods, so we wanted to go through a discussion of how we determine normal cost contribution rates and how the unfunded actuarial liability is amortized and present some alternatives for the board to consider. And when you're setting a funding policy, there are 3 basic objectives that naturally conflict. You want to ensure the security of the benefits. need to manage the stability of contribution rates and predictability of those rates so they can fit into a reasonable budget process. And ideally, you want to maintain some generational equity so that in theory, the taxpayers today are paying for the benefits of the employees that provide their services today. Now, those naturally conflict because in order to secure the benefits, you'd like to see as short an amortization as possible so that you make up any unfunded liability over as short a period as possible. But if you want stable contributions, you want to spread that over as long a period as possible. So you have to balance these competing objectives, and it's really a policy decision on how you balance those objectives. And I'll let Ann talk about GASB and a few of the other things.
This slide summarizes the GASB implications on funding and as it relates to the current funding methods that SFRS has adopted. And it's a review, it's really just a review of the items that we covered in the September board meeting. And what that was is there are 3 changes that would need to be made to SFRS funding methods in order for the same discount rate to be used for your funding valuation and the GASB calculation. And those 3 items are just to pre-fund supplemental COLA, to close the amortization period on your gains and losses, and to make a minor modification to your asset certificate. The treatment of the supplemental COLA, that valuation and how that is valued was raised by GASB and also in the Milliman audit. And as I just said, GASB requires that the supplemental COLA is pre-funded, and Milliman has suggested in their audit that suggested changing how that supplemental COLA is recognized, how it's recognized once it's granted, and that's if the supplemental COLA is not going to be pre-funded. Given the requirement that the plan must first fully be funded on a market value of asset basis, either pre-funding the supplemental COLA or recognizing it as it occurs are both acceptable methods in our view. And this slide represents the recommended changes that Milliman suggested in their audit on the calculation of the normal cost contribution rate. In short, we concur with their views and their recommendations, and the impact that it would have on SFRs would be a 150 basis point increase in the plan contribution rate based on the 2012 valuation.
You said 150 basis points on the contribution?
On the contribution rate.
On contribution rate?
As a percent of payroll?
Yes, as a
Okay.
percent of payroll, yes.
And tell us again, why would there be that increase for the fully funding of,
No,
tell me what that.
It's for the normal cost calculation, and the way that it's calculated, there was a change in methodology that they implemented.
Oh, then, okay, thank you.
And what does that mean in dollars?
Give us some examples, what that does to the plan.
it's a dollar.
Well, we've got those in the projections, if we could wait and get
Okay.
there, we'll show you, and then we can deal with that.
That answer's coming up?
Yes.
Yes.
Yep. So we can go into more detail then. The next slide, amortization method. When we talk about amortization or amortizing the unfunded, we're talking about how the unfunded as a debt is paid off. The easiest illustration is the same thing as like a mortgage. In order to determine the appropriate method, there are some things to consider. One, as Bill said, is generational equity. Are you paying something off during the period of time in which it's being earned by the members? So are you paying off a benefit during a period of time that the members will be earning that benefit, or is it going beyond their working lifetime and moving into another generation? for retirees or early retirement incentive programs, so you're paying it off over a short enough period of time because the benefit is going to be almost immediate, and you're taking on debt and need to pay it off. Gains and losses. Each year we do evaluation, we determine how the fund's experience is against our assumptions. To the extent that there are gains or losses, how far do you spread those in recognition? If it's too short, you'll create volatility in the cost amounts for the city. If it's too long, again, you may be pushing those gains and losses off into future generations. The California Actuarial Advisory Panel has suggested a period of 15 to 20 years is appropriate for amortizing gains and losses, and the 15 to 20 year mark is typically what your average future working lifetime may be for active, so that ties in with the generational concept. Assumption changes. Your assumptions, many of your assumptions are very long-term. Mortality assumptions go out a very long period of time, and so the question is, do you amortize those over a different period of time? And here CAP suggested 15 to 25 years to reflect those expectations. I probably missed this page. Yeah, page 7 was, when we looked at the charter gives the board flexibility. It says that amortization periods should not be longer than 20 years. So anywhere within that range, and you're meeting the current requirements under the charter. You already have a policy that's in place, which is what has been applied, which is benefit increases are amortized as a level percent of pay over 20 years. That means that your amortization payments, your mortgage payments, if you will, are increasing each year over a 20-year period at the assumed payroll growth rate, which is potentially going to be 3.75%. Gains and losses are over a rolling period, which means we take the accumulated gains and losses and re-amortize it each year. It's the same thing as refinancing each year, so that what you're paying is the first year's payment of a finance plan, which means you're paying the interest and typically a small portion of principal. Milliman suggests amortizing benefit increases over a shorter period of time, amortizing the supplemental COLA over a closed period, and the rolling period for gains and losses, while not preferred, is a generally accepted practice. What we've typically seen, and where that may have come from, is that well-funded plans where the plan is fully funded and they may become unfunded one year and surplus the next year. A rolling amortization is very effective in smoothing the volatility of that type of funding. But a rolling amortization doesn't get to the heart of paying off an unfunded liability specifically. And so I think when the policy was first put into place, this system was fully funded. And at this point, a rolling amortization isn't going to tell you that at this point in time, you will be fully funded. Only through more gains than losses will you make up some of those past losses. So the question of closed or rolling amortization is a component of a philosophy that says what point will you be funded, and whether you want a policy that says our target is to be funded at a specific time. Let's close the amortization instead of allowing it to roll. For some rolling amortization periods, you never pay the unfunded off. If it was, if for example, for illustration, you were having a rolling 30-year amortization, you wouldn't even be paying the interest on the unfunded, which means that that fundamentally would result in an unfunded growing each year. You are not extending it out that far, and that's the reason I believe that Milliman said in their audit that It's not preferred, but it's not a problem for the system. So rolling does a great job for mitigating volatility. It does not provide a specific policy for fully funding, getting a plan to full funding.
I'm gonna, we tried to put a picture to some of those words, and these two graphs show the amortization under closed and rolling methods of a hypothetical $1 million. So this is not your specific numbers, but just a hypothetical $1 million. The top graph shows the pay down of the principal, and the bottom shows the actual payments that are made each year. So the red line represents a rolling 15-year method using 7.5% interest and 3.75% amortization payment rate. The purple line represents the closed 20 years on a level percent of pay. So the purple line is what you're doing right now for propositions. The red line is what you're doing for gains and losses. And the blue line is if you took that 15-year period you're doing for gains and losses and just closed it. So you would actually pay it off over 15 years. The thing to note is under each of the closed methods, the actual payment increases each year by 3.75% over the amortization period. So you start with a low payment and you increase over time. And that's designed to remain a level percent of payroll because we expect payroll to increase by that same amount. Whether it actually does or not is a different question that we get into. With the rolling, the amortization payment actually declines each year because you're paying off just a little bit of it and then re-amortizing it over 15 years. So instead of next year only having 14 years of payments left, you redo it and say, we're stepping back to 15 years.
Excuse me, when you look at our past history and you take maybe the last 20 years, are we averaging about 3.75 increase in our payroll? What are we?
That's actually in our other presentation, but it's
Somewhere around there. It should be close.
Higher? Yeah, that's what I was assuming.
yeah, over the last 10 years, you've only averaged 2.5, but over longer periods, it's been higher.
And can you tell me-
The last several years
Yeah.
are,
Because I'd like to know, I know we defrayed wage increases for a long time, but then again, the city paid the contribution for the employees during a certain period for 8 years. So that's why it may look a little skewed. So if we actually looked at it at a 20-year period, it wouldn't look as skewed, and you'd actually see what the wage increases were.
yeah, so.
Even 30 years would be
If you,
great.
in our economic assumption review report, page 15 gives
Uh-huh.
the number for various periods. For the full period from 64 to 2013, we averaged 4.6%.
Okay, so
But it's-
64 to 213, it's 4.6%.
Yeah, but
Okay.
if you look at that, there are significant variations over periods.
Right, but see, that's the problem. I mean, because, when you're, trying to do this and you're taking these shorter periods of time, you can really impact your plan. We're assuming 3.75, but if you really look at the plan, it's been, since its inception, 4.6. That's a pretty significant difference.
Yeah, but the assumption, well, we should address that in the
Okay, yeah.
economic
Okay.
assumption review, but that's a forward-looking assumption. And
Uh-huh,
we're
right,
not
right,
projecting the
right.
high
Yeah.
inflation periods that we have when you look at
mhm,
it.
Assumptions.
But that is a critical
It's
assumption.
a lot of years. I mean,
It-
you're
it-
still
it
looking at a
affects-
lot of years, and you're still looking at time periods when inflation was very high during that time. So you're saying 64 to 2013, you had some enormously high inflation periods. So I think that that's probably a good amount of time to look at what's the average going to be over a long period of time. And so when you say 3.75, that's actually lower than it's been.
It is.
But we're choosing an assumption of it over a much longer period anyway,
Yeah,
not just what
yeah.
occurred in that 10-year period.
Well, no, you're looking 1964 through,
I'm talking in the inflation assumption in general. The big change here is going from rolling to fixed to make
Yeah.
sure we definitely pay it off.
right.
Yeah, here we're focusing on the amortization method,
Yeah.
rolling versus fixed.
Mhm.
If you, if this was a higher number, you'd see these lines be steeper.
Mm-hmm,
Yeah.
yeah,
And, actually, I'm not sure, at some point, if we got that number high enough, the rolling 15 would not pay the interest. Because of how
That's right.
steep this gets, it gets low and then
Mhm.
high. And so this projection would be more like what Ken was talking about with the longer periods, or like what you would have with 20 years, where you can see that it starts increasing in the first few years because we're not paying enough to pay off the interest on
Mhm.
it. But if you roll that and re-amortize each time, you're never paying more than the interest. So that projection would show that line just continuing to go up. So that's the dynamic to understand about the
Yeah.
amortization methods. We can get back to the actual wage inflation assumption. But that leads also into the other question on the amortization method is should we be using a level percent of pay, a pure level percent of pay methodology? That is the most common method in the public sector. We design things to be a level percent of pay. We try and project how payroll will increase over time, and we try and design the costs to take that into account. And if we're right, then those amortizations are a level percent of pay. But there are risks, because if pay grows by less than that amount, each year your payment will be a higher percentage of pay, and so your contribution rates go up. If you have growth and pay grows faster than what we've assumed, your contribution rates go down. That's not as big a concern.
now,
The-
does that take into account, let's say, for the last 20 years, 25 years that plans have spiked?
Spiking is a separate issue where, and we have some assumptions to address the history here, but that just goes into our projection of what the benefits are that we're paying. And so that's a separate issue. The wage inflation here is the
Mhm.
across
Okay.
the board increases that we're seeing. The typical alternative method is much more like your mortgage, where each payment on the amortization is the same dollar amount. It's a level dollar amortization. So if we determined your amortization payment was $1 million this year, that's what it'd be for each of the years in the amortization period. Theoretically, then that should be a declining percentage of pay over that time. So your biggest hit to your contribution rate is in the first year. And theoretically, you can set that increase amount anywhere between 0, level dollar, and what you assume payroll to increase. So you can use that as a mechanism to control the risk. And I guess part of the reason we raise that is some of the systems that have gotten into the biggest trouble, part of it has been that their wages, the growth of their city has not kept up with what the assumption is. Obviously Detroit's the outlier where they have a 40, 50-year history of declines. But that is a risk to the system. We're planning on a stable population going forward. And as long as that assumption's met, things work out well. When it's not met, we can run into problems. So if you look at the level percent versus level dollar approaches, here we've got the same graphs, 3 different amortizations, all 20-year amortizations. And they just vary. The red is a level dollar payment, so you see the principal declines following this red line, and the payments stay level at about 90,000. The purple line is the level percent of pay. It's the same purple line we had on the prior graph, and it starts low and ends high in terms of the payments. And then we just put in the 2.5% annual increase, and you can see how it's a little flatter somewhere in between on both the pay down and the payments. So, putting all this background information together, we had some, and including Milliman's recommendation and other things, we're looking at some possible amortization methods for you to consider. For benefit changes, the theory kind of is average expected future working life. And this was one of the things that drove GASB to change their methodologies, is they were concerned about benefits being granted to people about to retire and then amortizing that over 30 years, and whether that was appropriate. Now, you weren't doing that, so I'm not pulling that out as what you were doing. But the idea is if you increase benefits, that should be paid over the remaining future working life of those who receive the benefits. Typically, we see that works out to about 15 years. But it would depend on what your benefit change is and who it's targeted to. We also suggest you might consider a minimum of something like 5 years, so you don't have to incur the full cost all in 1 year. That can be extraordinary. The charter obviously has a maximum of 20 years, and we wouldn't suggest any changes to the current charter agreements. Just pay them off as they're scheduled to be. For assumption changes and gains and losses, we suggest considering the period up to 20 years with no negative amortization, meaning the first year payment should be at least equal to the interest amount, so that you're paying things off. Then the supplemental COLA, we're not going to have that for a few years because we have to be 100% funded and then have good investment returns. And we agree with Milliman's suggestion that it should be a closed period, but we wanted to study this a little bit more carefully to look at how those excess assets come through the asset smoothing method and the amortization, so we could match it up, come up with a methodology to potentially match it up with the benefit change. So we suggest deferring a decision on that. We don't actually have to deal with that. We do think you should consider using closed periods instead of rolling, and that the amortization payment increase, you might consider whether that should be less than or equal to wage inflation. We modeled 4 options following that on the gains and losses. A closed 17-year level percent of pay. Now remember, the longer the period, the more stability you get out of it. 17 years as a level percent of pay was as long as we could go and still have the first year payment cover the interest on the amortization. So that's why we chose 17 there. And so those annual payments remain level as a percentage of expected pay. We suggested another alternative is close 18-year level real dollar, which we would take your inflation assumption, the price inflation assumption, instead of your wage inflation assumption. So payments would increase. The current assumption for next year would be 3.25%, and so your amortization payments would increase by 3.25% each year. We looked at, if we went out to 20 years, what would we have to do so that the initial payment was still interest? The largest kind of rounded increase we could get was about a 2.5% increase. And then you could look at level dollar. Here's a comparison of the impact of those on the 2012 valuation. We have that graphically as well as the table of numbers here. I'll just go to the bottom line. In the 2012 valuation, we calculated an employer rate of 24.82 before the floating contribution rates with members. Just make the normal cost change, that goes up to 26.29. And then the first three alternatives on the amortization would bring that down into the range of 25.6 to 25.9. The level dollar kicks it up to 28.14. So the longer amortization periods help stabilize the contribution rates. The lower growth rates reduce that risk of contribution increases, but you pay more upfront for it. We have baseline. We showed projections here, and I can get them up on the model if we want to look at any variations. But this is how the projection for the just the new normal cost rate method works out. The red line is the 2012 valuation projection. So there's a slight increase over it all the way out. And under the current method and just changing the normal cost, one thing to note is after 20 years, we expect to be 96% funded, not 100%. As soon as you close the amortization period, you get to the 100%. We have some built-in gains so that it temporarily goes above 100% and then back. And what you see on the payments is they go up a little bit higher and then they remain flat during that amortization period. You get some drops here when various propositions are fully paid for. And then ultimately it drops way down when you have paid off all of those amortizations and gotten to 100%.
Excuse me, have we distributed these additional charts to the board? Because they weren't part of the original presentation,
I was
so.
thinking we had.
Okay, I'm
You're-
sorry.
You're right. I apologize.
No problem.
Well, not that they should.
We'd asked them
The one before that.
run
This is the
these
conditional.
charts reflecting all the options that they're presenting, and
Okay, great. That's the problem.
I had mine and I was following along when I was looking at it.
Can I ask you a question, whether?
Yeah, go ahead.
2012, you have 7.58. Is that ending June 30 of 2012, our fiscal year? Or-
June 30, 2013, so it's the 12 to 13 year.
Okay,
I'm sorry.
the one question I have, we have the preliminary results for fiscal year 2013, which were 13.01%.
Yes.
So to me, if you have, yes, it's just a preliminary, but 13% is probably pretty close to what the actual number was for the fiscal year just concluded. Can you do an abracadabra and put 13 in there?
Yes, that's why I brought the model here.
Happen to have
So,
already run that. yeah.
Okay, good.
so let me just put in 13, can I
Yes.
round to 13?
And then you have to say abracadabra.
Abracadabra.
There you go.
And that change incorporates the smoothing of that gain?
Yes. So this is just with no changes, so you drop down compared to the prior.
While you're at it, for the next one, we are 5 months into the fiscal, because we have the numbers, I think will be presented later on today, of about 5.3%.
I would suggest that,
That's a
Why don't we
little
stick
bit-
to
Yeah, that's a
this?
little, we don't, yeah.
I would suggest that the 13% return is only
Yeah.
one piece, and a
Yes.
more important
Yeah.
piece is the actual liability changes.
Okay.
And that's unknown at the current time because they haven't processed the valuation. So the further we go, yeah, we're up 5% for a
Yeah.
quarter. We're getting further away from reality because like we always say, we can guarantee this will not happen. So the further away we get from
Okay.
things that won't happen.
But obviously, this would understate it, because so far, so good.
Oh,
It's high.
generally speaking,
Okay,
good news.
which is
Anything above
conservative.
7.5
Right,
will be good news.
and I guess the other thing is, for the methods, we really want to focus on the pattern of costs that you're seeing, because they're going to apply in a variety of economic situations, more than just, what the specific costs are. Adding the 13 gives you an idea of where that bump is in 2015. But especially when we're looking at the amortization methods, it's the pattern that you're using to pay them off that's critical.
May I interrupt for a moment, so I'm on the same page as you? When I'm looking at the 2012 baseline, this doesn't contemplate any of the changes that are proposed today, is that correct?
Correct.
Okay, just want to make sure I'm following.
Nor the 13%
Nor the
return.
13%. This is what we reported to the city in February of this year, earlier, assuming we made 7.5.
Before you make any more changes, can you pause on that for a sec so I can make some notes?
We can have print screen.
Yeah, I can print these.
Before we vote today?
We're not voting today.
I thought today was,
27.6 versus 29.
did I not read this right? Recommendation with changes?
Yeah, President Marcus has requested that we have the presentation and defer
Thank you.
till the
That's
January meeting.
I missed that one. Okay.
Okay, so first, if I put in the
And
change to
1%
the
at
normal
end.
cost method.
1.5 at the end.
See that?
1%.
And then, if I change this to 17 years and layers is the closed layered amortization.
I'm sorry, Bill, what did you change?
I just got to the 17-year layered,
got
so
it.
that's comparable to your second, to the second graph.
Illustrations on page 14, we're going to show you each
Okay.
of those four alternatives.
Okay, got it.
So this is the first one.
This is page 20 of the charts.
Yeah,
Yeah.
the supplemental charts, it's the second one,
Page 20 should
but adjusted for the 13%.
be. Right.
Got it. As the most recent fiscal year to date, ending June 30 of 13.
Yeah. Now,
Now, should-
keep in mind, this is all based on the 2012 valuation. I'm modeling it, assuming you put in 17 years starting in 2012. That's not what we're even talking about doing. So it's really focused on the pattern.
Do you
And
want to
and what
leave
you
the
s-
13 there now, as you move on, or do you want to change the 13?
Well,
Yes, so tell us.
I can do it either way.
I mean, tell us, do you like it or dislike it when we come to you and say, oh, change 213? Because obviously you didn't put it in there, I mean,
No, no.
212. You didn't put it in there,
The
so.
purpose, the value of the model is to answer your questions.
Yeah.
In terms of where things are going.
Right, right. I mean,
Okay, but I think what Bill's doing is, if we bring it back, what we want to do is use the model to show you the value of the four alternatives.
Yes.
Right.
So whether we use the 13 or we don't use
Yeah.
the 13, it is what's happening when they change. So I think we're almost better off without the 13 because the
That's what I
line
think.
reflects
Okay,
the
Yeah.
let
current
me,
status without the 13, and looking at these four alternatives, you can see what it does to the current projected funding requirements.
Does having the 13 in there, I don't understand that. Why we're using a number that's a year old when we've had a significant change in the past year.
Except that we assume long-term, we're gonna make 7.5.
Yeah,
So
right.
That,
Just make it
that
as a
line,
long-term.
the line that we're showing there is without the 13. And so what we're suggesting is take the 13 out so you can see what the difference is in the funding patterns against what they otherwise would be before the 13% return.
Yeah.
then we can go put the 13 in so
Then
you
we
can
can
see
put
what the
13
levels
in,
are.
because you can say, all right, this funding pattern shows that costs are gonna be higher. And then they're gonna drop off because we're closing the period. Then you could say, then we could show you, well, if we put the 13 in, then you can afford this pattern because in fact it will now fall below, and that's one way to utilize the excess returns that are going to reduce the funding. But first, to compare these four items, let's start with the same baseline.
So when we get new printouts for discussion, can we have actual numbers from the past year so that we have a real baseline going forward?
We can put the 13 in.
But it's only part of the picture.
But, yeah, it's only part of the
Yeah.
picture. You won't know until we actually do the valuation and can assess the liability as well as the
I get that,
assets.
but what you're talking is 2012, 2013, and there was a big jump between the 2 years. And I think that the member contribution rate, the city contribution rate, those are all important things to think about, not in the context of 2012, but in the
Yes.
context of where we are today.
No, I understand. I agree.
So why is it 2012, not 2013? Is that the
We've
beginning
not
of the
completed
fiscal
the
year? or the
evaluation.
end?
Beginning of the
for
plan,
2013.
yes.
It's the beginning of the plan year, that's what I was, okay, that's what I
Right,
thought.
yeah, that's the beginning of the plan year. That's the last valuation
Got
we've
it.
completed and done all the modeling on.
That's, now
And
explains
so-
it.
All right, so
Um,
let's show these 4 alternatives that are on page 14.
Yeah, so the key thing here is after 17 years, you've essentially paid off the unfunded liability. And this goes above 100 because you have some asset gains in the 5-year smoothing period that haven't been recognized. And so those come out a little bit later. And so it reverts back to 100% if we continue the projection. But,
Wait a second, if you have 7.5% each and every year, there's no carry forwards. There's no smoothing.
If you look back at our last 5 years, we have gains and losses built in that come out over the next 5 years.
Yeah, but not in the year 2029, 31, 20, 33.
No, but then when they come out, it takes 17 years to
Oh, I get it
recognize.
now.
We smooth for 5 and
Yeah.
amortize.
Right.
for-
Yeah.
5, so.
And, okay, this is all coming-
Effectively 23 years before you get all of it out of your system. It's a long time to wait to get it out of your system.
So the next alternative was to go to 18 years, but to reduce this from 3.75 to 3 1/4, which will give a slight bias going forward towards downward rates. And
That's page 21 of the additional material.
so the places you can see that are where we don't have propositions coming off, but there's just slight declines in the rate in these flat areas. And that's that bias. We're saying, this is modeling saying actual pay goes up by 3.75%, but the amortization payment only goes up by 3 1/4. So it gives you another year out to 2031 where you're still paying a higher rate before you start dropping down because we've extended it to 18 years. And with the change there, 2.92. Then, if we push this out to 20 years and still try and keep the first payment to be greater than interest, we go to a 2.5% payment growth. And so now the higher rates extend the full length of our projection because they're going out a full 20 years. But that gives you more stability and kind of a slightly lower rate as you're out in this area.
That's page 22.
Which is page 22. Then the last alternative we showed is if you went to the level dollar, which is the way your mortgage would be done. Here you start seeing you see a much higher payment to start with, 32 instead of 29, and it's the next page on your statements there. But you see a much more pronounced downward projection because we have payroll growing by 3.75 and your payment amount stays level.
Now it's when I throw in the 13% to see whether that pays.
I
If you
don't think so.
Well, except for the first few years.
Yeah, you end up with,
So that's what I was saying before. Then take the layering on top of that of a favorable investment return to see if, in fact, you have a more conservative amortization schedule. And much of it's paid for by the extra return, except for the next few years, but it's a challenge.
so, I'll go back to the,
Is there something in those 4 you just showed us that you would not recommend?
Well, one of the, and Bill and I debated over this, one of the reasons we selected those 4
Yeah,
was because of concern. It's becoming unpopular to have this negative amortization. That is, when you're amortizing on an increasing basis, where your beginning payments in that schedule don't actually cover the full amount of interest on the unfunded. So we designed all of these to say that as a minimum, the first payment will cover the interest on the unfunded, so that you can say, we are amortizing, we are paying off the debt. Once we got past that, these are effectively neutral in terms of that criteria.
Yeah, so all of these alternatives meet that criteria. And then they vary with your projection of how much the amortization payments go up versus how long a period.
Then after that, it's kind of preference. It's what Bill said at the beginning of balancing volatility with consistency. Amortizing as a level percent of pay or something slighter, lower than a level percent of pay will effectively give you consistent budget numbers. Plan cost X percent of pay. Amortizing as a level dollar says it's kind of the same thing as when you might have bought your first house. It was stretched, higher costs, but as your pay goes up, those costs become a decreasing portion of your payroll. So you start off higher, as Bill's pictures show, but the cost as a percent of payroll declines.
But do you have one that you like specifically? I know you don't like tails, but that's what we're hearing, I mean, that's what we're asking you.
They don't have to pay us, so maybe we should ask somebody else.
Yeah, no,
But I know, it's a
yeah,
fair
I'm not
question.
saying I'm gonna, take what they said as the, but I wanna hear your personal, which one would you
We
recommend?
probably have different ones.
Well, you're gonna get different opinions, so you'll get them right now.
Okay,
Fixed period, so that you can make a statement that says you're targeted to
so
get
tell me
this
which chart you're
unfunded.
talking about, what page?
They're all fixed periods.
They're all
Okay.
fixed.
Well, except for just making the normal cost rate change where you have the
In other words,
15-year roll.
right now you have gains and losses rolling,
Yeah,
so fix that period. Okay, so that you know what your gain and loss is, and you know when you're gonna pay it off, or get credit, or for how long you're gonna get credit for it, because that's very predictable. My preference is more level dollar, because it means you're biting the chunk off now with a greater expectation that prospectively things will get better, costs will go down. Okay, but it's a balancing item, because this is, this is a revenue item and has to be budgeted.
so you're kinda saying you like to take the hit a little early and pay it now, and then it takes a little less risk off the plan later on, or less pressure.
Yes,
To-
that's
yeah,
where
it
I come
tends
from,
to,
but I'm a
like,
saver.
Right, it's a,
It's a preference.
If my brother was in the room, it'd be something different. One's a saver, the other's.
Well, but
Bill?
it's been the dilemma of a lot of plans where they said, I don't wanna do that, I wanna push it out, let the next guy worry about it. And
But
that's,
maybe we'll get
yeah.
gains that'll take care of it.
right, maybe we'll get, right, and I think the whole country now realizes that a lot of plans kept saying that for years and years and years.
The trend is turning, because there are plans in the news all the time. How do you keep your plan? What's your favorite, Bill?
So, I think all four of these are very reasonable
so-
in gradations. But
Yeah, come on, I mean,
no, I'm sincere,
Yeah.
thank you, Bill.
no, I mean, I think what
No,
you're saying is
really,
all four are fine,
all
and they're all
four are-
fiduciarily,
absolutely,
fine.
they are absolutely
Generally,
good.
You'll find them anywhere
Right.
across the country.
Yeah, well, and in fact, if you look across the country, there are a lot of systems that have some negative amortization, either just to start with, or some of them permanently. And so, all four of these methods are a significant grade above that. So, I think we're definitely comfortable with any of those four methods. I personally don't go as far as Ken towards the level dollar. I do like level dollar, but it can mean a pretty substantial hit up front. And so I personally debate between these two in the middle. And probably because you can get 20 years here at 2.5, that's probably my favorite. But it's marginal.
Yeah.
Are we
We're
good with presentation?
We're good with
Okay.
presentation. We're
Then I
done.
will open
We're
up for
just-
public comment on this item. Then I'll open it up to questions by the commission.
Hi, my name is Richard Rothman, and I wanted, about the supplemental COLA. There's still a lawsuit, and it hasn't been settled, and I think there should be at least a footnote somewhere in this study saying that, mentioning the lawsuit, and I guess it could go either way, but I think it's just prudent to mention that somewhere in the footnote. Thank you.
Great, thank you. Anybody else, any other speaker? Seeing none, I'll close public comment and open it up for questions or comments from the commission.
Let's see. Regarding the supplemental COLA, I'll start with that. None of these methods change the actual total liabilities, correct? The supplemental COLA is, one of the numbers is the total liability.
Well, none of these methods put a value
On that supplemental, that's another
Right.
maybe contingent liability, okay. The question is, the other requirement is the market value of the fund. Would either one of these methods get it to achieve the market value greater than the actual liability? Because one has the dollars coming in sooner, faster than the other. We don't have a duty here to increase benefits, but we have a duty to pay the benefits. But that's just one of those things that what we decide here today will affect that benefit.
Yeah, so if you look at all the projections, the top graph shows the gray is the liability, the green is the projection of the market value of assets, and the orange is the projection of the actuarial value. They're so close now that when we run this out, they merge. These funded percentages are on the actuarial value, but since they're the same, you can apply them to the market value. And as soon as you choose one of the amortization methods that closes it, you get to 100%.
I agree you're trying to, I understand you would like to select a message that would prevent any negative amortization, correct? That I agree with. The thing is about, depending on which method, the slower pay means the arc line stays higher longer.
Yes.
Right, that's when you want, where are we gonna be 20 years from now in terms of payment, okay? I think my colleagues know, but based also some of the participants, the cost is now cost increases are now being shared by the employees, it's not all on the employer. So some of us are very sensitive to our contributions going up. They're going up no matter what. This is another thing that would, all these methods drive it up further, though I think the employees were capped on some of the increases, not the employer. So that's why I'm saying we should be sensitive to the employer and the employees about the effect on their disposable income and their budgets, whichever method we choose here. So, I mean, we try to keep it down, but which brings the issue we mentioned earlier. We're trying to keep the contribution volatility to a minimum.
Right, so I think one of the reasons we were trying to, staying within the parameter of paying at least the interest, we were looking at pushing the period out as long as possible. While that keeps contribution rates higher longer, it also reduces that volatility in the short run. But that is a trade-off.
Yeah. So that's why the 17 level, lower now, but longer. Same volatility though as the 20-year level.
But you're saying less vol at 20.
Yeah, less volatility.
Because more
at
going,
20,
dollars going.
Right.
But you pay it off faster at 17 or 50.
Right.
And that's at a fixed period?
All of them are closed. All of them are closed. We want to do that.
That's what I'm sure.
Any other questions?
That's my switch.
Are we wrapping up? On your model, could you put for 2012,
Yeah,
11? For 2013, No, for 2012, put the 13. 2013, put 11. 2014, put 9. So I can see what that looks
And
like.
what amortization, what, current?
The 15-year.
15-year rolling.
And 375. There you go.
Interesting.
So that's your current amortization method with those returns.
And just to clarify, the 7.5 is what you're recommending here. Currently, it's 7.58.
That's correct. Currently, the board adopted the phase-in, and 7.5 would become effective with the 2013 valuation.
My understanding is.
wasn't what they recommended.
My
It's what we-
understanding.
It's already in, that was your initial resolution.
Yeah.
For the phase.
We recommended
So it's
that.
in place, in theory, isn't it?
My understanding is the board votes every year to do that. It doesn't vote years ahead to do that.
Last year, we asked you to sustain your decision from the previous year. This year, as we have in the board item, the following board item, we've asked you to sustain your decision that you made 3 years ago to phase in over 3 years. So you're right. But for their modeling, unless the board changed it, the phase-in would be completed effective July 1st,
Yeah,
2013.
my point is just this, the charter gives the board to set the contribution rate for 1 year. It doesn't give it the right, in my understanding, to set the contribution rates at years in the future.
Oh, I thought you were talking about the discount rate.
The 7.50 to
Is the
7.58.
Discount rate.
It's not the contribution.
Yeah.
We
Yeah,
do
yeah.
set employer contributions based on valuation results.
Yeah.
But we have, last year as well as this year, provided the board the opportunity to sustain or not sustain their decision for 2 years
And we will be bringing this item as an action
Right.
item, so.
in January.
We'll have the right to vote on the number we collectively support.
Based upon the numbers that are there with the more relevant return numbers, can we turn the cost share on so we can see what happens to employee contribution rates?
I will tell you that from the charter, 28% employer contribution rate is the cutoff for the next incremental increase, and it would be 0.25%. So anything of a gross employer contribution rate back to the previous chart of anything above 28 will trigger not 0.5%, but 0.25%. So it would either be 4 1/4 or 3 3/4, and that's the charter. And then the next cutoff is 30. So.
And what was this prior year's, what was the employer contribution rate with the cost share? Was it 20?
24.82 gross
In which year?
in the current year. And it's projected without any of these changes to be right around 28, just under 28, assuming we made 7.5. And so that would, as long as it was below 28, it would not trigger an additional contribution requirement for the employees. But if it goes over 28, it would trigger another 0.25% for those folks who are impacted and currently cost sharing with the employee.
I thought no change goes north of 26, which would increase employee rates too.
There's a plateau of about 4% where it stays the same, and 28 is the trigger for an additional quarter. I mean, it was incrementing at 0.5% or a full percent, and we went up for a full percent with the increase to 24.8, and then it sort of hung there. We could go all the way up to 28 before the next requirement for the employee to kick in additional money kicks in.
When you provide some updated, well, first off, this is helpful seeing the varying scenarios. You know, like I know we did a couple months ago. It's very helpful. When you provide the board with an updated version of this, can you please just update the unaudited return for 2012? Is it 13%? Is that what we're doing? Or whatever the
13.1.
13.01.
With zero.
What's it called? The unaudited number, or what's that? What do you call that?
Preliminary.
It'll be audited.
Preliminary.
Yeah, it'll be audited by the end of this month.
Okay.
Well, actually, what we could do is, we have the unaudited financial statements.
Right.
So we can because this has presumed cash flow in contributions and benefit payments, we can rig a number there so that the assets match.
Rig is probably
You-
not.
that- I would say
Correct
that's-
term to use.
Back solve for the percentage return given
Professionally
our
estimate.
cash flow that will result in the market value of assets matching.
Professionally
Yeah.
estimate.
Rigging is technical.
Right, it's an actuarial term of art.
That's a fireman's
It is.
term,
I
actually.
have to admit, I
Which one?
appreciate that.
Rigging.
But so that you have the
Rig-
actual
rig-
assets of the fund as of
Yeah.
6/30/13.
I think that'd be very helpful because I'm sure everybody in the board is mindful of the health of the pension system, but also the frequent changes over the last 4 or 5 years for employees.
Yeah.
Yes.
And since we're doing that, could you use 7.58 as well, which is the number that we've agreed upon? I mean, you're hoping.
That isn't it, yeah.
Commissioner,
Kurt.
I would just like to point out that, since the board adopted the 7.5 three-year phase-in in December of 2011, Chiron has always shown the future years as 7.5%.
Understand that, yeah, and that's why I'm asking for 7 point. I understand that.
On this projection, does it or does it not include the normal cost change?
This does, right
That
here.
1.5%'s in there?
Yes.
Okay, so that's gonna make it go up already, okay?
Okay, I'll wrap up this. Did you answer the question for the 1.5%, what it meant in dollars?
So there's about a 2.4 billion.
2.5 billion in payroll, so 1.5 is 30.
730.
37, 38 million.
Okay, great. Okay, great. Then we will wrap up this item and move to item number 3.
Okay, we will be very quick here. You have both our PowerPoint presentation and the full economic assumption review report. We're not recommending a change from the phase-in that you had adopted in the past. So there's a significant detail here in looking at the investment return assumption, the price inflation assumption, and the wage inflation assumption. But we'd like to just skip and go to questions. Any questions you have on it, we can pull to the appropriate slide to deal with those questions.
Great, then I will open up the public comment first on item number 3. Seeing none, I'll close public comment, and now we are open for questions and comments from the commission.
Want me to start?
Start.
Okay, I'll start. Well, first of all, the discount rate is a big deal in terms of coming up with that, because it does drive the returns. Let me just tell you the one problem I have. This is a public fund. A lot of people just got to get used to living in the public world. The perception of this, how is it going to come off to the members of the public? We're all familiar with the Detroit plan and the assailing of DB plans, defined benefit plans, which are dying breeds. That's really what DB should stand for. The issue that I have is, here the board is looking at our returns, 13% for the last fiscal year ending June 30 of 2013. The first 5 months of this fiscal year, we've got over 5%, so we're certainly well on that way. So here we have very high numbers, yet we're decreasing the expected return assumption, number one. Number two is the inflation assumption. We're also decreasing the inflation assumption. And we've had this discussion before, and my conclusion is it's only the economists and the actuaries that believe inflation is going down. That's kind of the conclusion that I have, because when I go shopping, I'm paying more, and I think it's going to continue in the future. And quantitative easing is the big deal. You can't put $2 to $3 trillion in to print money and then have a buyback period where you're paying for that with inflated dollars and not have an inflation impact going on. And I know we talked about tips. I know your response to that is, oh, the treasuries are yielding, you're getting your inflation forecast from the tips. The treasury inflation protected securities, which is your real rate of return. So you're using that. To which I would respond with, the government the Fed is buying back a lot of the treasuries, which has an effect of lowering that price. Sorry, if they're buying them back, they're going to raise the price, lower the yields. So my point is this, or I have several points, but the fact that in terms of the price inflation, the the numbers I see are going up, number one. Your process in terms of coming up with them are the real yields on the tips and those kinds of things, which I think are manipulated. You know, I do. So the point I like to make is that I see inflation going up. I see our returns high. If we adopt these numbers here, the public will say, wait a minute, you've got great returns. You're banking a 13% return and a 10 or so percent return, while you're decreasing the inflation assumption, all of which, let's face it, what's the impact? All of which raise the employer's contribution rate. So I see this as a big PR nightmare, frankly. That here you have a lot of public pension funds that have drawn a lot of fire from a lot of people throughout the United States, and here we are looking at very high actual rates of return and voting to lower the actual rates of return, which will have the effect of increasing the contribution rate. And I just see that as a cycle that I just want us to be mindful of. That how does this play in Peoria, if you will? And I just don't think this plays well in Peoria. What can I say?
Peoria was a client of mine, sorry.
It's a metaphor, Your Honor. I don't know.
But I would also remind us that we're at 80% funded.
Yes. And do you think the average member of the public
Well, I think the public
has any
would-
appreciation for that fact?
I think that's what they're focusing on, whether you're healthily funded, and sort of there's an informal guideline that if you're less than 80%, you're not potentially, you might be the DB as you describe it. But I mean, we are healthily, relatively speaking, funded. And I think that is just as important, and that's how we explain away that we don't bank on a good 2 or 3 year stretch. This is very long term. I want, you know, you have Peoria as your client, so maybe you should or Jeanette can weigh in, but I didn't hear a question there necessarily. But I think, you know, from the answer of how does this survive PR, I think more people are focused on is their ability to pay, and they're looking at not what we assume the return is what the funded level of the pension is. And that's how we defend it in the public eye.
Yeah, would you like to add some?
I'm not going to weigh in pros and cons on that argument. Anecdotal evidence, slide 7 of the presentation, shows that the general trend continues that public plans, large public plans across the country continue to decrease the discount rate because it's a measure of risk, but to the extent that they can remove future risk off the table, they're moving in that direction.
One point I want to make, and I want to thank Jeanette for providing the other funds as well. But one thing that we're not seeing in these slides, or the ones you provided, is the risk of the portfolio. Or stated differently, our portfolio has a very high percentage on a relative basis of private equity investments, which is one of the reasons why we are so well funded. I mean, let's show the implication of that. So because we have a higher proportion of private equity as well as in real estate, which are typically higher returning asset classes, we should be at the top end of the expected return. Because among those funds, we have a very, very high degree of volatile assets. And I would add to that our emerging market debt, which is a big number, which has had which has been the highest performing asset class, public or private, incidentally. So, for us. So we have a lot of asset classes that have generated some very, very high returns. So I would say that going forward, we would certainly expect that. So what I didn't see in your analysis, which is difficult to show, is the fact that San Francisco has one of the riskier funds, so we should have among the higher expected return numbers.
Well,
Would you agree with that? Is that a fair characterization?
well, I think what we showed is, given your asset allocation and your investment advisor Angeli's assumptions on that asset allocation from when they did the last asset liability study, the median expected return under those assumptions was 7.1. And so that should be reflecting your asset allocation. Now, I know we have another one coming up, and that's part of the reason we're suggesting not changing course here is let's wait until next year when we do the full asset liability modeling study, and perhaps we can work with your staff and Angeles to get better refinement on this, because I know one of the issues is these are kind of broad asset classes and don't take into account some of the sub-asset classes that you have. But still, the assumption based on that was only 7.1. So, you know, it's just hard from the hard data that we have to go the direction that you were talking.
Yeah, and in all fairness, let me just rebut that point. The fact that the expected return for stocks, and Angela said it was about 7.5% round numbers, was the 7.5%. You know, frankly, I think that's conservative, 7.5%. Over the long run, you know, it's been 10%, or it's been 12, since 1926, it's been 12% on an arithmetic average and 10 and change on a geometric average. So anyway, just in terms of, because we look at long numbers, but the numbers that we're using are both smaller, both the arithmetic average as well as the geometric average over the long term. So anyway, well, I'm sure we'll revisit that issue, but my point is this: the long history in the past for stock returns is lower than what we're using forward, the 7.5 number that we're projecting forward.
But then again, when we had Cliff Asness here, and we had Howard Marks and other of our top managers, they said more in the 6% range was the expected return.
For stock.
Yeah. So, you know, those are big differences of expected returns from our own managers. And those are our aggressive, distressed managers who take more risk.
Much like the other numbers, these are not what we expect to make next year or the year after. These are very long-term numbers. That's why the inflation number, there is not just pressure, there are countries trying to drive their inflation up. These are long-term numbers. That way when the volatility comes along, we don't have to start adjusting the rates again to capture that volatility. That's why it may not make sense today, but over the long term, these numbers make sense. I don't want my contribution rates to go up, but they are. I don't want the city's contributions rates to go up, but they are. Because we didn't drive them up when the market went down. We did not do that. We've been through that phase before as well. So keeping the contributions smooth is one of the objectives here.
Yeah, I think stability for contribution rates and stability for the city is probably one of the most important factors here.
Well, actually, I was gonna make the same point that he made on the discount rate, that, and perhaps that data you can share with the commission is that most plans, you are correct, in terms of, in order to mitigate risk, the discount rate, they're decreasing that. So, I don't know if you have that data, you can show it, but I've seen it in other plans across the board. In order to, and that's how they're managing the risk.
We can provide the phone with that data. We just,
So-
the database has just been updated last week, so
Yeah, I
we
saw-
can give the details behind this graph and
This,
what this.
that would help, I think.
Yeah, this is the distribution over time
Yes.
of the assumptions used, and you can see the higher assumptions are gone. 8%, which used to be the vast majority,
Right.
is now the higher. Median assumption is in the 7.5 to 7 3/4
And that's the
range.
decrease I've seen over the past 18 months, so, yes.
Yeah, and this is
But it's
kind
something
of the
that-
latest information here, and then this is the same information currently for 30-some California systems. So the details from these data are in the back of the full report that you have.
So, and I think that
Shows you
benchmark
each
has-
of the systems, and for the California systems, the median return expectation is 7.5.
And what's CalPERS?
7.5.
7.5, that's why I wanted to bring it up, because when you do the benchmarking, you look at that, in order to mitigate risk, you see the downward slope.
But 7.5, we have a riskier portfolio, so we should probably have a higher expected return.
I haven't compared your
No,
portfolio to CalPERS.
Brian, anything on your end?
I do, I just have a couple
Okay.
questions.
I know.
By lowering the discount rate, where does it shift the financial burden? Does it shift it to the city? Do they have to make up the difference by lowering the discount rate?
Yeah, and essentially, your discount rate is what is used in the budgeting process to shift between contributions and expected investment earnings. So when you lower it, you lower your expected investment earnings, and that has to be made up in contributions. That goes directly to the city's contribution rate, And then if that hits the triggers, then it could also affect the member contribution.
So in prior years before Prop C, when the discount rate was lowered, it was effectively hurting the city in the form of a higher contribution rate.
Only.
Only. And then in terms of price inflation, when price inflation goes down, what is the effect on contribution rates?
There's no direct impact on contribution rates. The price inflation can be thought of as a component of some of the other assumptions of wage inflation and the discount rate. As long as your price inflation assumption is above 2%, it won't affect what we assume for your retiree COLAs. They're capped at 2%.
So refresh my memory on the price inflation. What does that plug into?
Well, we look at the relationship between the discount rate, price inflation, and more directly between wage inflation and price inflation. So theoretically, what we have is a wage inflation assumption of price inflation plus 50 basis points, meaning that on average, you'll make up 0.5% in real earnings each year.
And then on the wage inflation, can you explain to me where that plugs into the model?
Yeah, so that plugs in two places. It's on the individual level when we're projecting what benefit they'll receive. It's based on their final pay. And that wage inflation is the across-the-board increase we expect for people. There's also a piece that changes by years of service that we call the merit increase that goes on top of it. But that's the across-the-board. So when you reduce that, we are reducing people's projected pay and their projected benefit. Then it also affects, if we use a level percent of pay amortization, it affects the amortization pattern.
Thank you. I usually good at about 75% of that, and I always forget the last 25.
Okay, good. I think I'll wrap this up. Great. And this will come back in January, correct, as an action item? Super. Thank you very much.
Thank you.
Okay, item number 4 is continued to the January board meeting. Could you call item number 5, please?
Item number 5, review and approval of RFP for portfolio monitoring and securities litigation evaluation and reporting.
We have asked the city attorney's office to prepare an RFP that they will be issuing, and we're asking the retirement board to approve the issuance of the RFP. This is to hire law firms up to 4 is what we represent in the background information, law firms that would monitor our securities litigation, and we're also looking to expand our current services into the international portfolio. So we would ask that you approve this so that the city attorney's office could issue it and actually report back to the board once the process is complete. I don't know if Katie has anything that you'd like to add?
I'm happy to answer any questions if the commissioners have about the process or the proposed search.
Great, I will open up for public comment on this item. Seeing none, I'll close public comment. Questions or comments or a motion?
Yeah, I'll move we adopt staff's recommendation and approve the request for proposal for securities monitoring and litigation service.
I'll second that.
Discussion on the motion. Seeing none, all those in favor?
Aye.
Passes unanimously. Thank you. Item number 6, please.
Item number 6 is request for adjustment disability pension adjustment from 50% to 52%, Darren Brannon, and this is a valid vote. We will need the written ballot returned.
Great. I will open up for public comment on this item. Seeing none, I'll close public comment and ask everyone to cast their vote. Could you please call item number 7?
Item number 7 is the executive director's report. Mr. Bush.
Jay Huey's Executive Director. I have listed 2 items on my administrative update. One is to remind you again that the 2013 mandatory harassment prevention training must be completed by December 31st, 2013. This is an online program, generally takes at least 2 hours, and the certificates need to be returned, of completion need to be turned into the board secretary. Second issue is we wanted to put on everyone's radar that we are planning a retreat. Most of you hopefully recall that you were asked to complete an education needs survey where we ask all the board members to sort of select topics as well as the method that you want to receive education. So all of the board supported the concept of having a retreat. We've had a couple of them in the past. It will be somewhere in City and County of San Francisco. It's generally away from this building, nicer setting. It's a public meeting. We generally hold it for 6 to 7 hours, and from the survey, that seemed to be what the board was asking. And the topics that I listed here were from the survey of the board members, the issues or the items that they felt the highest need for education. And so, again, we're not here to settle what the agenda will be, but we are, just want to let you know, we're going to target it for February, March. We will be focusing on these topics as to what we would set up as an agenda, and we expect to have more information for you in January. The other thing I would like to point out is we have distributed, not in the packet, the 2004 regular meeting schedule, which has the regular board meetings and the regular committee meeting days. And I just wanted to point out that the January meeting is the only one that is off the cycle of second Wednesday of each month. It is now scheduled for the 15th, which is the third Wednesday of January. And so we have the regular committee meeting date a week later on the 22nd. Otherwise, February through December is the second Wednesday of every month, starting at 2 p.m. for board meetings, the following Wednesday at 3 p.m. for committee meetings. The other thing I'd like to remind you is we are having our staff holiday party tomorrow, and I think you've all received your invitations. We hope to see some of you there, and on behalf of the staff, I would like to wish you all a very happy holiday season. We'll be seeing some of you next week at a committee meeting, but others we might not see till after the New Year, so our best wishes for a very happy New Year. I'll be happy to answer any questions that you might have.
Great, I will open up for public comment on the Executive Director's report. Seeing none, I'll close public comment. Questions or comments from the commission? Great, seeing none, we will move on.
I do have a question. Well, how will the retreat topics be determined, selected? Because some may require speakers, which we've done in the past.
I think we intend to use the survey results the way we've used them in the past, and that will be to try and carve out an agenda. We'll pass it by. But as far as who's going to design it, I would believe staff would come forward with a draft proposal and request that I guess I shouldn't say request the board approve it. Hopefully the board would accept it and we would go forward with planning it.
And maybe to help out Commissioner Driscoll, I chatted with Jay a little bit about looking long-term for most of what should be on it and what committees can do. From what popped out on the survey should be directed to committees. For instance, security lending program. I don't think that's a long-range issue. That's more an investment committee issue. So I'm confident the executive director will distribute the interest in the appropriate direction so we can get the best out of our one-day program.
Okay, well, I'll just, rather than tell Jay later, maybe I'm not the only one who suggested governance, but I've said it many times over the last year. When we did it at the UCLA Business School, there was about 12 sessions. I would say 7 or 8 of them were on the subject of governance. I thought to bring them here, it would take at least 2 half-day sessions, meaning 2 different retreats. You're not going to do it all in one day. And there are other topics. So in terms of counting time, who's doing it over 7 hours, 1 or 2 of these things will take up the whole 7 hours.
I will tell you that these 5 topics were identified by 5 out of the 6 board members who responded to the survey as either a high or a very high priority for education. So we will bring in a segment, whether it will occupy, I don't believe it will occupy the entire retreat, but there's no restriction. We have plenty of resources to hold multiple retreats. We're lucky to be holding one a year. I went for many years before we had a retreat, so I think it's a good exercise. We just want to make sure that we get one in the first quarter of next year, and if we need a follow-up, we obviously would have the ability to do a second one. But we wanted to make sure you understood we were not controlling the topics that we're looking at. They were feedback from majority of the board.
Fantastic, thank you very much. Could you call item number 8, please?
Item 8, Deferred Compensation Committee report, Commissioner Dansgaard.
So we had our Deferred Compensation Committee meeting yesterday. We've been meeting on an annual basis so that we can closely track the transition from Great West to Prudential. One of the things that we've insisted upon is this monthly meeting, and so we're going to be meeting again on the 8th of January. The progress with the transition for Prudential has been described as significant. The one thing that we're working on, staff has been working on, is finalizing the agreement, working through all the exhibits and the language, and it sounds like there's not any significant holdups. It's just there's quite a bit of documents to work through, but they don't expect any delays in the transition in January. But in front of you, on the table, there's a calendar. And what we did is we asked staff to create this calendar so that we can track progress as opposed to getting a sort of a verbal presentation every time. We actually can see what things have moved and where they are on the calendar. I think we're all comfortable with the transition to Prudential at this time, not worried about any significant delays. The other component of what we were tracking was, of course, the transition to Galliard and Stable Value Fund. That's also an ongoing process. They're working through documents. Staff told us that they expect to get that done in time for the transition in January as well. And then one item that we reviewed was, or 2 items that we reviewed was the transition letter and sort of the intro. That's going to go out to all members of the deferred compensation plan. Is it all city employees or just members of the deferred comp plan?
The notice of the transition will go to active participants.
Active participants, thank you. So we reviewed that, working in the right direction, and that's looking to go out here pretty soon as well. And then one other item that we talked about was trying to get the word out to all the different participants. You know, sometimes people get something in the mail and they don't always read it. And so we've directed staff to basically create a list of all the unions that have participants in deferred comp.
Good.
And sort of their plan of how they're going to contact each union so they can help get the word out so that the transition goes smoothly. And that's my report unless I missed anything.
Great, any questions?
Yeah, I do. The mapping from the Great West funds to the new funds, how is that going to be done?
There's no mapping.
There's no mapping?
There's no management changes.
That makes it easier, doesn't it? So it's just the same,
It's a
all the
tran-
same funds
The
coming?
word transition therefore is more accurate about what's going to happen.
Okay.
But she has to supervise all that.
Yeah, so none of the funds then, it's just the stable value, really, that's the only one?
The management changes.
The management changes, okay. That makes it easier, doesn't it? All right.
Yes,
It does. It does.
relatively speaking, yes.
It does.
Anything else?
So anyway, just to summarize, so they'll have the same funds after as they had before?
That is correct.
And the fees will be pretty much the same after as before for the funds?
There'll be some slight changes, and we're working on that right now.
Okay. Higher or lower?
Some are lower.
Well,
Okay, a little bit, okay, fair enough. Thank you, that's it.
Great, I will open up for public comment. Seeing none, I'll close public comment. Thank you for the report. Could you call item number 9 next?
Item 9, review and approval of target date glide path, Julia Durant, Deferred Compensation Manager.
Julia Durant, Deferred Compensation Manager. And this presentation is going to focus on the custom target date funds, which we have had for a little over a year, almost a year and a half now. We've invited Russell Investments to review the modeling that was used to create the target date funds, the intended goals of the target date fund, and participant outcomes, and then present the recommended glide path change. And here to present is John Freeze of Russell
You got
and
it.
Keith Lennon.
Perfect. Well, thank you, thank you, Commissioners, for your time. I'm John Freeze. Nice to see you again. So we are here to seek approval for a modest glide path shift in the custom target date funds that we have for the deferred compensation plan. It's really the result of a pretty extensive demographics review that we've conducted over the last year. The change to the glide path is only a modest shift in the level of risk taken closer to retirement. The asset allocation underneath the glide path is not changing. So essentially, it's just the level of risk taken. So a few weeks ago, our colleagues Keith and Josh Cohen were here to present to the investment committee. There was an extensive discussion just about the changes. We were going to go through a relatively high-level summary, but happy to get into as much detail as you'd like. So slide 2 essentially just is a reminder of the modeling process that we use for the glide path construction. And we'll just go through this very briefly. Essentially, we collect demographic data, and then we break that demographic data down into distinct population groups. So for your plan, it's miscellaneous and safety. We use that information to create a custom income replacement ratio. So that's just the amount of income that's needed based on a participant's final year salary. Then we identify exposures that we would want to include in the glide path. As I mentioned earlier, those are not changing. Then we optimize the glide path using custom income replacement rates, savings rate salaries, salary growth rates, and retirement benefits. And then finally, we test the glide path for effectiveness for populations that may not be ultimately what we're designing for. And just a reminder, we do design the glide path primarily to serve the miscellaneous population, but then we test the effectiveness for the safety population. And that's just because the miscellaneous population is more dependent on the DC plan to fund their retirement going forward. So slide 3 just gives a summary of some of the observations that we had in the changes in participant data from the original demographics review back in June 2011. We observed different participant compensation levels, and essentially they increased dramatically, and you may have seen that in the report. So happy to answer any questions just about the change, but essentially after kind of a thorough review of what had happened, we realized that the information originally provided to us just had incorrect salary information. And so fortunately the impact on the modeling process is actually pretty modest, just given the way that the information shifts in the income replacement rate. But it does make the investment problem a little bit harder. So happy to answer any questions if you have any, but it also was discussed pretty extensively with the investment committee.
Great. Questions?
Okay. So in the most recent demographics analysis, we didn't receive a distinction before between covered and gross compensation. And we elected to use a gross compensation figure because that includes overtime pay. And after discussions with staff and others, we felt like overtime, or including overtime, essentially was a more conservative assumption, and that many participants actually kind of depend on overtime given that it's relatively consistent. And then we also elected to exclude non-contributing participants for modeling purposes. So those who are not participating in the plan, we don't want to factor into the savings rates because that will just lower the overall savings rate. So we want to design it for those participants who are saving. And then since the last demographics review, Proposition C was passed. That affects new hires, but not the majority of the population, so we are not factoring in the Proposition C into the modeling process for now. We can have a discussion about making that change down the road, but the existing population is almost all covered under the prior legacy benefit. So slide 4 just provides a breakdown of the original demographics, which are shown in the right-hand column, and the updated demographics. There's no change to the career length or the retirement age for the miscellaneous population. It is age 62. As we discussed earlier, the salary information for employees close to retirement did change dramatically, up to about $89,000, but the contribution rates in dollar terms did not change. So the rates themselves fell, as a result of the incomes rising, but the contribution amounts, I should call them, being static. And so you can see that the contribution rates range from 3% at the start of a career to 6% by the end of the career, and that compared to 7% up to 16% originally in our assumption. So underneath that is a new line that describes modeled contribution rates. So one of the things that we propose in this analysis is the fact that using the contribution rates that we observe with the latest demographics review, you would actually have very low probability of achieving the income replacement target that we are modeling for. And so what we recommend is to use a modeled contribution rate that is a little bit higher, that gives you a probability of success that's in that 75% range. So essentially the modeled contribution rates go from 4% up to 10%. So essentially if we use the contribution rates that we're observing for the plan, the probability of success would be very low. And ultimately that would, if you wanted to achieve your income replacement rate with a high rate of success, you would essentially have to take an extraordinary amount of risk throughout your career in your investment portfolio. So we believe that it's better to include modeled contribution rates because they are essentially giving those participants who are contributing at a reasonable amount a high probability of achieving their income replacement success. Any questions just about the actual contribution rates versus modeled contribution rates?
Commissioner Driscoll.
It's more of a request than a question. The assumptions that underlie the way you designed the glide path, perhaps we could at least put that in a footnote so a member could look at that and see whether those assumptions apply to them. I know it's not a one-size-fits-all.
Okay. Yep.
But there's something, well, I am Plan 2, or it might help them, especially if you're going to put the target replacement ratio in there.
Okay. Yep.
Just in the footnotes.
Okay.
And then you can tweak it later when we figure out how to capture the Tier 3 people that are been on board for less than a year, but some of the older Tier 3 people may really need to understand they should save more rather than what the model says.
Right. Okay.
Yeah, I do have a question. Yeah, on your slide, page 5, I'm just, can you walk me through that?
Sure.
Are they supposed to add to 81? That's my first question. Are the pieces supposed to add to 81% replacement?
So the 81% is the starting point.
Yeah.
Yep, and then so essentially the first bar is actually a decrease. So it may be actually better to have a minus.
Yeah, I get
in front of that line, but it is shown visually. So essentially we're starting with an independent income replacement rate study from Aon Consulting, Georgia State University, that determines the income replacement rate for the observed compensation levels. And then we make an adjustment. So they actually assume lower contribution rates than we are seeing with your plan. So there is a slight adjustment. But if you compare it to the original chart that we prepared back in 2011, that percentage shrinks.
Let me ask my question this way.
Yep.
If I had those numbers, do I get to 81?
Yes, you should.
Can you show me? I'm not good with numbers, sorry.
Okay. There may be some rounding involved, so that I don't know, but essentially it's 81 minus 9, which would be 72, plus 27, which would be 99, I believe.
Okay, and that does.
Yep. And then subtract 40 for the pension benefit, so it'd be 59. Subtract 35. 54, 24, yep, and that gets you the 24%.
So if you have 24 plus 35 is 59, plus 40 is 99.
Yep, and then subtract 27.
99 minus 27 is 72, plus 9 is your 81.
You got it.
Okay, I get that. Okay, so that's how you get the replacement. So you mentioned earlier in your comments that the bottom line, net is that you'll increase the risk of the holdings. So are you tilted more towards stocks, away from bonds?
Yes, so the glide.
And how do I know that by looking at this?
The glide path chart is shown on slide 6. So the income replacement rate is essentially just used to determine, that minimum level threshold that we're modeling to make sure that participants have a high probability of hitting that.
Yeah, I get that.
So the glide path itself and the change is shown on page 6. So the current glide path is the light blue,
Yeah.
the light blue line, and we are recommending moving to the dark gray or black line.
Yeah, I need some numbers behind that before I
Yes.
move from, so anyway, the following page, page 7, is the proposed, so that's your suggested?
That's exactly right.
Do you have the original here someplace, or do I gotta check?
It's in the appendix.
It is, okay,
Yep.
good. Because that'll show the differences.
So just to clarify, the amount of risk taken at the point of retirement is increasing from 35 to 39% in growth assets. So those would be equities plus any real assets such as real estate, commodities, infrastructure, and then the fixed income will be the difference. The actual allocations that we are proposing are shown on slide 7. And the characteristics based on Russell's capital markets assumptions are shown below.
I'm looking at your page 7 and your page 16, which is your before and your after picture.
Yes.
And I'm trying to get an idea to say, where is the percent increase in equities?
So we use the term growth assets
Okay.
because it
Okay, fine,
covers-
growth assets.
Yep. And that is shown right here on slide 6, so it's jumped.
See the
Well,
y-axis?
7, you have total growth.
Yeah, I can't read the numbers, there's no numbers in that. No, I'm looking for the actual portfolios, I'm looking at pages 7 and pages
So the
16.
middle of page 7 in the middle, the
Yep.
total growth category starts at 90 for the 2055 fund,
Okay,
and then goes across to 39.12 for the retirement fund.
yeah, got it.
And you can compare that then to
Okay.
the slide 16, which
Okay.
would be going from 90 down to 34.
Okay, no, this is the substantive issue, that's why I say page 7 and 16 is really what you're looking for us, or, from us in terms of our ascent.
Approval, absolutely.
Yeah, so that's why I
Yes.
wanted to focus on that, not that
Yes.
chart there. But in essence, we were moving more towards stocks and growth,
Growth assets.
growth assets,
Yep.
as opposed to fixed income and cash.
That's correct.
And it's funny, the change really doesn't come that much until the 2035 class.
No, that's exactly
If
right,
you will.
yep. That's exactly right. And you can see the slope, this chart on slide 6
Okay, I get it.
shows you the slope of those growth assets over a career.
Okay, that's clear.
Okay.
That's clear. Have I talked to you about, have I convinced you about small yet or not?
Well, as we've explained in the past, we do have a modest small cap
Okay.
bias, especially that comes through from both managers and from a modest bias that we include. So we do include biases toward emerging markets and small cap. And so we still have some bias, just not, I think, the extent that we had originally talked about a couple of years ago.
All right. Thank you for your presentation.
Yep. So I think the only other, slide 8 just gives you kind of the breakdown from the DC sourced assets to the combination of DC plus other DB benefits. And you can just see the difference between modeled contribution rates and median contribution rates, so those that are observed. And you can just see in the statistics that are shown on that page that if you use the observed contribution rates, and we had an income replacement target of about $21,000 a year, the median outcome that, based on what we would observe would be, or expected, would be about 16,000. So even it would, even the 75th percentile outcome in terms of market returns would only get you to 20,000. So that's why we believe that using a model contribution rate is really a more prudent approach than actually using the observed contribution rates. Now, for participants, they always have two choices. One is to increase their contribution rates now and save more, or the other alternative is to consider a later retirement date. So in the modeling analysis, we are not assuming a later retirement date. We are suggesting that participants increase contributions, but the alternate is always that they could continue at their current savings rates and just defer retirement a couple of years.
Great, did that conclude the presentation?
It does.
Great, I will open up for public comment. Seeing none, I will close public comment. Questions, comments, or a motion?
Well, it looks like Commissioner Rivera.
Yeah, I did have one question. For the slide you just talked about.
Yes.
Page 8.
Yes.
Obviously, you have expectations of the returns for the various asset classes?
That's correct.
Are those in the appendix someplace?
I don't know if we actually included the breakdown. We easily could do that. These are based on our September capital market forecast that Russell uses globally. But we could follow up and.
Yeah, I'd appreciate that. Do you have, out of the top of your head, do you know what the number is for stocks, just for US stocks?
Yeah, it's actually very close to the Angela's number at 7.5%. I want to say it's 7.6 as of September.
Okay.
Is our expectation.
And do you have a process that you go through to come up with these numbers, or do you use Ouija boards?
Oh, no. We have a dedicated capital markets
Okay.
team, so it's a couple of PhDs that generate capital markets for Russell's clients globally.
Okay. Thank you. What's wrong with Ouija boards? I don't know. I'm getting looks here, like.
Just the one comment on the building bars on their page 5. Interesting thing I thought about when they put the 3 floaters on the right. We've used the phrase 3 legs to stool forever.
Okay.
The fact they put a 24% number in this example for the 3rd leg, that is people's savings goal if they want to have that 81% replacement. So when they put numbers on the stool, on the legs, excuse me, I think that really helps them so they can understand why they cannot rely totally on the Social Security or their pension here. And these are based on average numbers, meaning the 40% number is sort of an average worker in this group, which is the whole glide path is trying to fit everybody. So it's an average goal for everybody.
Seeing nothing else, Chair will entertain a motion of staff's recommendation.
I'll move that we adopt staff's recommendation.
Is there a second?
I'll second that.
Any discussion? Seeing none, all those in favor?
Aye.
Passes unanimously. Thank you very much. Item number 10, please.
Item number 10, review and approval of investment guidelines for Galliard Stable Value, Julie Brown.
Julia Duane for compensation manager. As part of the transition of the stable value investments, we have prepared investment guidelines that will guide the investment manager and our stable value manager and staff, Angeles, and outside counsel were instrumental in developing these guidelines. And Leslie Kaus with Angeles Investments will present the recommendation.
Thank you. This is Leslie Coates from Angeles. The guidelines are before you. And just a brief reminder, of course, you currently have Great West as the stable value manager. In August, the board approved hiring Galliard. Galliard will be sort of a multi-manager portfolio, which will include Great West for at least a time. But Galliard will really have discretion to allocate to other managers. So there'll be much more diversity in the management of the portfolio, as well as diversity in the wrap coverage, the insurance provided to guarantee that credited rate, which we think is a lower risk position than having all one manager and all one wrap provider currently. The guidelines are quite detailed. They reference different kinds of portfolios and different kinds of contracts with limits on each. There is, I think that one salient point, and I'm happy to take questions on any of this. I've already mentioned a major difference is number of manager, number of wrap providers being more under the new portfolio structure. But also we've pulled back the allowable duration in the portfolio, which under Great West was could be as high as 5 years. And so this would be as high as 3.5, although it may be somewhat higher in a transition while we still have Great West. There's also a somewhat lower allowable rate to mortgage-backed securities. That's been a concern that the extension risk, the interest rate risk that comes from those was perhaps too high, so that's trimmed back. And there are various other credit quality guidelines, other sector guidelines, and really a very comprehensive set of limits, which Galliard will be responsible for monitoring and reporting on in a very detailed and regular way. So maybe I'll stop there and see if there are any specific questions about this.
Great. Before questions, I'll open up for public comment on item number 10. Seeing none, I'll close public comment. The floor is open for questions.
Yeah, I did have a couple of questions about this. First of all, I think everyone should know, particularly the participants should know that the reason why the credited interest rate is decreasing is because you're taking less interest rate risk by pulling in the duration, so that you get less of a current income when you have shorter bonds. Because I think that came out with a lot of the discussions in terms of the credit interest rate going down from 1.8 to 1.4, and that's one of the substantive reasons.
Well,
So
of
do you
course,
wanna-
Galliard isn't managing this portfolio and won't be until January. The crediting rate decline that we've seen this year is really due to bond market
Yeah, yeah.
conditions. That, bond markets are off about 1%, and that has to be reflected in the crediting rate.
Yeah.
So it's, the crediting rate we've seen so far is really due to entirely conditions related to the current portfolio and bond markets, not these guidelines.
Really? So what you're saying then, if I could just paraphrase, that if we would have had the same existing managers, it would have gone down by 40 basis points anyway?
Well, we did have the same existing
Okay,
manager.
so that's what it, okay. So would there be an additional lowering of the interest rate then, because the yield curve is upwardly sloping? And you're shortening maturity, so you're giving up yield to lower your risk?
I think that's probably correct. I think the same basic profile of this portfolio will be the same, which is that there'll be, we would expect to earn an increment over cash with very low volatility. So, sort of maybe some outside crediting rates will be, pulled in somewhat, but again, at a much lower risk portfolio.
Okay. A couple specific questions, because you talked about the number of managers. How many managers do you think Galliard would engage to manage the stable value fund? Just
Initially, while Great West is still part of this portfolio, it will be 3,
Okay.
which will be an intermediate portfolio that Galliard will manage, Great West, and then liquidity, basically cash. The guidelines allow for, I believe, 3 to 7. Yeah, 3 to 7. So, it could be anywhere in that range.
okay. And would it be would each manager manage a sector of the fixed income markets? Like there'd be one specializing in treasuries, one in mortgages, such as Great West, for example, and one in, say, corporates? Was that the way you envision it?
I think it would be more, probably more similar to duration. There would be a shorter and maybe more intermediate, et cetera. So that's probably more likely. Again, all on a look-through basis, these restrictions would be, need to be adhered to. And Galliard is, of course, mindful of the management styles of all these managers, including, for example, the heavy allocation of mortgage to Great West. And so the other parts of the portfolio would be less allocated there. But that's the kind of thing that will be reported on and, fully monitored by Galliard, and of course reviewed by us.
Okay, just one last area of inquiry is the wrapper, the insurance wrapper. How many names, and really, because you mentioned in your comments that it protects the crediting interest rate, right? So if you could just give us some more color and expand on what you're getting when you buy the insurance wrapper.
Right, so the insurance wrap, as an investor in a stable value fund, you make a contribution. That contribution earns a credited interest rate that is guaranteed for
3 months.
your
Count.
contributions, or not contributions, if you take money out, that your contribution will have earned that credited rate. So because bond markets go up and down.
I get that.
We usually don't, outside of stable value, you really don't get a credited rate. So, or a guaranteed rate. So the insurance really provides that crediting, or that security of the credited rate.
Let me ask you.
So when I said protect the credited rate, it didn't mean that it protects the level of the credited rate, which is very much going to be conditioned on bond market conditions and how the portfolio is managed, but it protects the declared rate is what you actually earn when you when a participant directs their contributions.
It's like insurance, right?
I think it's comparable. Yeah.
So let me ask you, phrase it this way. When do you collect on the insurance policy?
You collect if you make a withdrawal.
To that guaranteed rate then?
Correct.
So it's relative to what they actually earn versus what they credit? Is that what?
I guess you could say you collected when you, month to month, you collected because your balance grows by the credited rate. And if you withdraw the money, you will, that credited rate will be reflected in the amount that you are able to withdraw.
Yeah, but what is the insurance? I still don't get when
So the insurance would be if for some reason, for example, the portfolio has credit problems or interest rates
Decline in
have
price.
risen. So bond prices have declined. If this were just a normal portfolio, you would not be protected from that.
I understand.
You would, if you own the PIMCO core bond fund, you've had a negative return this year, and you will not have that in a stable value fund.
Okay.
Commissioner Driscoll?
Will the face value of the individual's account be protected or not?
It will be.
That's it. You pay for that.
One thing I just,
So it's the
this
par
is
value of
important
the-
to remember.
Yeah, the book value may go down,
Of
but
the member.
That's
that's what you're paying the insurance for.
That guarantee is for a participant directed.
Yes.
Right. There's a risk on the
So
sponsors.
So if the sponsor, terminated, people and people had to withdraw for that reason, or there are other contingencies where that guarantee does not hold. But it does, in the event of participant directed withdrawal, that is the insurance provides the guarantee that face value of the contributions plus what the credited rate has been over the life of the portfolio, or over the life of the holding, that'll be made whole.
Do you have, just one thing, I'll close. Do you have an actual example? Because I think this is maybe my area of interest exclusively. Do you have an example of that, like a live example where there was a payoff on the insurance?
Oh, it hardly ever happens.
Okay, that's, okay.
Because there are 1,000,001 restrictions, such as the one I just said.
I get you.
It's based on participant restrictions.
So how much are we paying for the insurance then?
It's one of the reasons why, is the insurance worth it or not? It's why we decided before we hired Galliard, and it's gonna come up in the next 5 years, whether or not we may stop the stable value offering and go to stable income. Lower rate, no wrapper, no insurance, this whole issue goes away, though we're trying to get the best and most for the members who are the savers.
How many basis points? Is it 20? That's my recollection. Is 20 odd? Is that?
It's a little more, it's more like 25 in the current environment.
I really would like to see some case where it was paid off. If I'm paying that much money for the insurance, I really want to see some payoffs that have happened. So if you could follow up with that, 'cause again, I'm just learning how this works.
The insurance
It's
carrier should
very,
be able
very,
to
very
provide
rare.
that.
Yeah,
It's very rare.
It doesn't happen, I mean, it's.
Well, why would you get it? I know, that's when your
Why
house
do you
burns
ever
down.
get insurance?
But it-
Yeah, I was gonna say,
Right.
it's
No,
kind of
but
like the old
house-
portfolio insurance, I mean, nothing happens.
Yeah.
Yeah.
It's the
Let me
same.
ask,
Could we self-insure?
Yes, we could, but.
I mean, theoretically, you could, that would entail big business risk that I don't know if a claim had to be made where
But
We
isn't,
meaning the city, because it's the city's plan, it's not SFERS, so it would have to be independently insured by the city as the sponsor of the plan. Because these are separate trusts, and so right now, we're taking participant money for administrative costs. And so if there was consideration of self-insurance, it would have to come from the sponsor, the city.
but isn't it really driven by there being a run on withdrawals?
yes.
Isn't that really the truth of what would trigger the insurance? A bunch of employees saying, I want out of this,
correct.
at
Sure.
a time that we're below $1 for $1.
So
Is that,
Yeah,
is that a
so
fair?
for example, in the heart of the financial crisis, when we switched from the
Yes,
prior
good
provider to
point.
this one, I believe the ratio of the market value of the portfolio to the liabilities, what had been guaranteed, was 83 cents in the darkest of the dark days. So if there had been a run,
There
it would
could
have
have
been
been.
very problematic. So there wasn't a run because of course everything else seemed to be falling apart at the seams, so people actually put money into this underwater thing. So there are a lot of paths this thing can take.
They probably
but-
didn't realize it was underwater.
Well, they did, because I told them. No,
No, but I mean.
But the guarantee was there.
Yeah.
Yeah.
But you see,
Promise to pay was
here's the
there, so it
reason
wasn't-
why it's not that important, because you really can't have a run on this, because you can't, an active member just can't take the money out. If you're a retiree, then you can withdraw the money out, you see. So you just have to trade among accounts, you see. Do you follow? So you really can't, to have a run on this, it's very, very unusual because you have the entire active population that's captive. They can't take the money out.
Yes, they
They
can.
can move,
They can move it.
They can move it to
move
another.
They can move it,
Yeah.
but that's, yeah, fine. You wanna move it from stable to a high-risk thing when the shit hits the fan, which is when they're gonna be doing this, you see. But the point is this.
They could have moved it to CAF.
It's really, yeah,
Well, we don't have a
which is
cap
there,
on
but
it.
the key issue is, the chances of a run are very rare because it's captive, particularly for the actives.
Could the member say, I promise not to take out my money for 5 years? And
No.
therefore, all of our investments are 5 years and lower term. So could they contract to
That product
maybe
is-
uninsure, if that's a fair way, so they can pick that up as a return? Because the practical part is, people are in it for a lifetime. And for me, the practical approach is to make sure the return is the greatest return we can give them.
That product exists, that is not what this product is.
And someone could say, I don't intend to take it in 5 years and then be laid off
Yeah.
a year later and need to have access to the money. But you're right, it's a separate product and it's never been designed to try and mitigate the cost of a wrapper by trying to restrict the access. You know, people could say, I have no intention of using or needing the money in the next 5 years, and they lock into that. It would imply that there's a restriction that you can't take it out.
And then you have
because
liability, and did they understand it, and.
But products like that do exist.
Yeah, we could put gates on it, and then the money manager will look at, then if I know the withdrawals are not for 12 months, it would change how they would invest. They could theoretically, again, get a higher yield. But the members, this is set up as a demand account. They can get it every day of the week. If we want to withdraw that from them, or they agree to it, they may want a little bit more, should expect a little bit more, but then it's a different management function.
But I think we should consider that, let's face the facts, even if the insurance wrapper costs 25 basis points, and you're earning 1.4 as your net number, that's a 1/6, 4 and 2, that's 1/6 of your income is going to buy insurance that you will likely never use. And if you try Victor's approach, where you have these separated baskets of maturities, I'm just making that phrase up, then you really don't need that. See, so I think we should.
Again,
But
that
that's a
is
different product.
A
Yeah.
different product.
Yeah.
I think our game plan is that,
Get it?
we are
Good
gonna do
idea.
this transition to Galliard, which I think will be a much better portfolio. The portfolio is now a little bit underwater versus the liabilities. We need to get it healthy, we need to get it over 100%, market value versus book. And at that point, there are many options that should be considered here.
Yep.
Short, stable income, non-guaranteed, maybe something like a sort of a term portfolio. I mean, there are many
Yeah.
options,
Can you-
and we should consider all of them.
Yeah, good, thank you.
And I would think that this type of discussion would be good in committee for different options, so we don't go back. So let me ask you, on page 9, where you have prohibited transactions, could you share why you have this category and the objective of it, and how you rate maybe what you called out? Because some of these stuff we do around here and our others have.
Well, actually, most of them don't.
I'm thinking of the last one.
Options we do securities lending, their leverage in many of our portfolios. These ERISA transactions are prohibited elsewhere in on the defined benefit side. We're typically not doing short sales. In fact, I know there could be short positions in currency, but I think mostly there are not short sales in this portfolio. So, most of these are actually very similar to restrictions you'd see in other guidelines. Are you talking about transactions or securities?
Prohibited transactions.
Yeah. So in the prohibited securities, there would very, most of these are definitely permitted and are things that can be done in the other portfolios on the defined benefit side. But these restrictions reflect, particularly for transactions, general practices, and as well, just a risk-averse stance of these portfolios.
Okay, thank you. Chair will entertain a
Can I
motion.
just, can I just offer something real fast, since it was brought up? One of the things that we talked about in deferred compensation was, what were really the goals of stable value? Why did people go into it some years ago in the bottom of the market? And I think if you talk to a lot of people, they said, you know what, I'm in stable value because I'm guaranteed a return, I'm not gonna lose any money. I don't really need the money now, probably need it in 10 years, but I don't care if I don't earn a return on it, I just want the money there. And so for a lot of people, although it may defy a little bit of conventional investment wisdom, that was sort of their sentiment. They wanted the money there. And so that's why stable value is designed the way that it is. If you have a $100,000 investment in stable value, and you're talking the cost of a wrapper at 25 basis points, that's $250 a year. And that's, it's not a lot of money. That's not gonna make or break your retirement. Now, one of the things that I was intending to look into after we complete the transition, echoing Leslie's thoughts, was that maybe there's a spot for another fund, and that's something we can look into next year. And I liken it to the whole iPhone, iPad, iMac problem that Apple tackled, right? They said they have an iPhone and they have the iMac, and then there's the laptop, but there's sort of something in between, and so they created the iPad. And maybe because of the change in the bond markets, which it's going to change again, maybe there's an opportunity to evaluate another fund, but the goal of that would be to provide a little bit more income return to participants without a lot of risk, but that's something that I think we can look into after the transition, which is really priority number one.
Good. Great. Nice. Staff's recommendation is approval of the guidelines. Entertain a motion.
So moved.
Any discussion? Seeing none, all those in favor?
Aye.
Aye, passes unanimously. Thank you. Item number 11, please.